Good evening, everyone, and thank you for joining us. Welcome to Ironwood Wealth Management's Market Insight webinar for the second quarter of 2014. My name is Nicholas Basso, and I am a Portfolio Administrator in Ironwood's Investment Division. Tonight, it is my pleasure to introduce our featured presenter, the Chief Investment Officer here at Ironwood, Mr. Sean Rogers. Sean is a charter holder of the Financial Analyst designation, and he also serves as Ironwood's primary investment strategist. If anyone has questions for Sean during the presentation, please feel free to type them into the question box on the GoToWebinar panel on the right-hand side of your computer screen. We will do our best to address all of the questions at the end of the presentation. And now, without further delay, please join me in welcoming Sean to lead this evening's presentation. Sean?
Thanks, Nick. Welcome, everybody, to another edition of our Market Insight call. I want to thank you for joining us tonight. Tonight, we'll be recapping the first quarter, and we'll try and bring some light on the remaining portion of 2014. We'll keep it here for disclosures for a second. So the topics we'll discuss, like most of our quarterly insight calls, and for most of you who are on the call, this is not new information, but there are some new folks on the call, so I'm going to start with a little brief introduction. So things we're going to cover tonight are returns and the environment for the first quarter of 2014. We'll try and look at what we think is going to happen the rest of 2014, and then we'll end with how that affects our portfolios and what our investment implications are. I like to start with this first slide to kind of show where we've been over the last 15 or so years and point out a few things. The first thing is not all of these peaks are created equal. We can see that although the S&P was at 1527 March 24th, 2000, and it was at 1565 October 9th, 2007, these two peaks are very different. And then we can see our new peak, which were pretty close to all-time highs on the S&P. We actually hit an all-time high on the Dow yesterday, and I think we did today. I haven't even had a chance to look, actually, but I think we were positive today on the Dow. We were at least on the NASDAQ. But regardless, each of these peaks are not created equal. We've broken it down into some valuation metrics, and you can see that although the index level was very similar in 2000 and 2007, we had a much different PE multiple in 2000 than we did in 2007. Now in March 2014, we have a very similar PE ratio as we did in 2007. Dividend yield. In 2000, we had a 1.1% dividend. You weren't getting paid very much to hold stock, at least as a dividend. 2007, we were getting paid a little bit higher than that, 1.8. And actually, March 2014, we were getting paid about 2% on an annual basis in dividends from the S&P 500. Now, the other thing we want to take a look at is where interest rates were during these periods of time. So in 2000, we had the 10-year Treasury at 6.2, versus 2007, we had the 10-year Treasury at 4.7, and then currently, we're actually, in March, we were at 2.7. As of today, we're actually closer to 2.6, 2.61. So each of these, it doesn't necessarily, just because we've reached a new all-time high on the S&P or relatively, pretty close to it, to an all-time high, it doesn't necessarily mean that we have a 50% drop ahead of us. Not all peaks are created equal. So that's one thing I wanted to start off with. We believe that on a historic basis, we're still fairly valued with equities. 15 to 16 times is historically where the S&P 500 has been on a PE multiple. One thing also I wanted to point out is even though the stock market has gone up, even though the price of the S&P has gone up 177% from the trough to the top here, if you look at total return, it's actually even better than that. With dividends, reinvesting dividends, you're at 208.3% on the S&P 500. So that is a fairly decent return over a 5-year period of time. That does not necessarily mean that we're in for a 50% drop. When we look at this on a longer time horizon, a longer period, you can see that the market has these periods of time, or has in the past had these periods of time where on a price movement basis, the market doesn't move very much, and then it moves a whole bunch, and then we've got another long period of time where we don't really move much on a price basis, but then we have periods, 20-year periods where we move up a ton, and then 15 or so year periods where we don't move very much, and then followed by periods where we move a ton. And then, the last 15 or so years, we really haven't had all that much price movement when you look at back from 2000 until now. We are above where we were in 2000, but not by a whole lot. And so it makes the last 5 years, it kind of puts it into perspective when we look at a graph like this. So no one knows where we'll head next, and that's why it's imperative to keep a diversified portfolio. And if you're a listener to this webinar on a frequent basis, then you're probably tired of me talking about diversified portfolio. But we don't know what's going to happen next. We have our thoughts, but no one really knows what's going to happen next, so we need to make sure that we start with a diversified portfolio. Into the numbers, Q1 results. Domestic equities increased slightly during the quarter. We actually really haven't moved all that much in the first quarter. Most of the indexes are very close to where they were at the beginning of the year. So last time we did this call, international equities underperformed domestic. As you could see, emerging markets were actually down slightly. Something that is important to note, the 10-year Treasury actually reversed course. We had seen the 10-year Treasury inching upward. We got above 3% for a while. It's since come back down. At the end of the quarter, it was at 2.72%, but like I said earlier, that's actually gone down to 2.6%. I think what we should be looking at with the 10-year Treasury is that it did not go back below 2.5%, or it hasn't yet, and it hasn't gone down to below 2%. So we keep hitting higher lows, higher recent lows, I should say, and higher highs, higher recent highs. So the trend is still upward with the 10-year Treasury, and we believe that trend is going to continue. However, last year, if we look at if we look at global stocks were up roughly 25% in 2013. Global bonds were down about 3% when you look at total returns. And so if you just looked at that, you'd say, okay, well, maybe we should be putting money into equities. They're doing well. Well, the first part of this year, exactly opposite. Bonds have outperformed stocks during the first part of 2014. Doesn't mean that it's going to continue to happen. It's just, things tend to reverse, and that's why we are adamant about rebalancing at least once a year with all of our portfolios, if not more frequently. ISM numbers, they were definitely choppy in the first quarter, but both manufacturing and non-manufacturing were above 50. We've had a lot of economists come out and say that the weather has been a big factor in economic data for the first quarter. During the first quarter, we had 177,000 new jobs created per month. That's about the same pace as 2013. We'll get April's numbers tomorrow morning. As far as returns for the first quarter, some of the asset classes that did not perform very well in 2013 actually are on the top of the list. So last year, commodities were down 9.5% for the year. Well, in the first quarter, they rebounded 7%. REITs only were up 2.9% last year. They're up 8.5% in Q1. So some of the things that may have been out of favor in 2013, all of a sudden now are in favor a little bit more. We had the S&P up 1.8%. We had small cap up 1.1. Like I said, developed international was up 0.8. Market neutral was flat. Cash was flat. Emerging markets slightly negative. The U.S. economy continues to improve, although it is at a slow pace. We just got GDP for first quarter yesterday. The estimate was for 0.1%. That's pretty anemic and much lower than the 3.4% that we saw in the second half of 2013. That's definitely a cause for concern. The reason that the market didn't pull back a ton yesterday when that news came out, I think there's a few reasons. One, the Fed is in play a little bit longer possibly. And two, a lot of economists believe that weather played a huge role in this first quarter. We had an extraordinarily cold winter, and the winter is being blamed for a lot of these choppy data points. So 0.1% is definitely something we want to keep an eye on. And that, once again, that's the first quarter estimate. We'll still get another estimate and a final number going forward. You can see that we've recovered all of the output that we lost during the recession and then some. And our long-term GDP growth at 3.1%, we're slightly under that for the fourth quarter and for 2013. So positives, some of the cyclical sectors are definitely positive. Autos are extremely positive. Auto sales for this month were for March were 16.3 million units, and that's the highest we've seen since February 2007. And you can see that this trend is very positive. Autos have had an extreme recovery, and we're back above the average, and we're actually, at levels we haven't seen since 2007, early 2007. So that's definitely a positive sign. Housing starts, not as quick of a recovery, and you can see we've had a little spike and a little spike down. Once again, this could be weather related. Also, we saw some interest rate spikes in the middle of last year, so that could also play to some slower housing starts. Real capital goods orders are looking very positive. The trend is very positive. Inventory was looking good. We spiked up a little bit this last couple of months, which we'll want to keep an eye on. That's usually not a great thing. But once again, and I hate to sound like a broken record here, but weather could also be a factor with inventory buildup. Consumer finances haven't really changed all that much from last quarter. The trajectory is very positive. Net worth improved by $14 trillion over the past 2 years. Net worth is a key driver in consumer confidence. Consumer confidence is a key driver in stock prices. So improved net worth definitely is a positive sign for consumer spending and the economy in general. Household debt service is still at very low levels. You can see by this chart here. And even with the recent increase in mortgage rates, homes are still very affordable. This is the consumer confidence I was talking about. We're getting back up to average levels, but we still could go higher. You know, we spent a lot of time down here at recessionary levels. We're just now getting back up to the average. A lot of the return from last year came from this confidence improvement, which equated to folks paying a little bit more for stocks. And when I say paying a little bit more, I mean paying a higher multiple. So consumer confidence has a lot to do with how much, with the PE multiple, or they correlate very well together. Federal finances haven't really changed all that much at all since last time we talked. They're definitely not as big of a drag on the economy as they were the past few years. You can see that by the budget deficit. You know, we pulled back the budget deficit dramatically the last couple of years, and that was a huge headwind. This year, we didn't pull back the deficit as much. So government hasn't been laying people off or you know, furloughing, and so that's going to have a positive impact on a marginal basis into the economy. Employment, well, we got down to 6.6% in January, and then February and March we actually spiked back up to 6.7%. When you get to a point where the economy has started to recover, and we think we've gotten to that point, you actually see the labor force start to increase because some of the workers who are despondent and were not being counted as part of the active labor force have now come back to looking for a job. They believe that their prospects are actually positive and that they maybe can get a job now, and so it's not out of the ordinary to see the unemployment rate kind of spike back up a little bit over a couple of month period of time while you see despondent workers coming back to the labor force. And you can see we've created basically all of the jobs we lost during the recession. We've almost created all of them. The problem is that it's been 6 years. So we're net at zero, let's just call it zero job growth, but 6 years has passed. So in 6 years, folks have been graduating college, have been, you know, entering the workforce. Now, granted, there's also folks leaving the workforce who are retiring, but we have 6 years of time, and no new jobs have been created. So there definitely is room to improve when it comes to the unemployment rate and creating new jobs. Inflation is not an issue right now, although we definitely want to keep an eye on it. I mean, you can see headline inflation is 1.1%. Core inflation is 1.6% for February. Those are not levels that the Fed is afraid of. Those are very low levels. The past 5 or 6 years we've been at about 2% inflation growth, which is a very good position to be in when you're looking at inflation. So the Fed is not worried about inflation. Things that will drive inflation up is when we start to see the labor market improve and we start to see wages go up. When wages go up, then inflation most likely will follow, and at that point, the Fed may have to act a little faster than they may want to. So we definitely want to keep an eye on wages. We want to keep an eye on consumer price inflation. But right now, the Fed is definitely not worried about inflation because it is so low. We'll talk more about this when we talk about the velocity of money. But right now, money really is just being held on banks' balance sheets or by the Fed as excess reserves. But we'll talk about that a little later in the presentation. Interest rates, the Fed, and QE. So interest rates, like I said earlier, it definitely is important to note that we went from 3% to 2.72%, and actually, as of today, we're at 2.61%. That was not the popular consensus interest rates starting to head down. I would say the consensus was that interest rates were going to keep trotting upward. We believe that this is kind of a normal back and forth, and that you can see that since 2011, 2012, we've seen increases in interest rates, although, you know, we've kind of come back, and then we go to new recent highs, and then a little bit higher low, and then a new high. So we think that we're going to start to see that trend upward to get back to real yields of around 2.5%. So our real yield right now, we have inflation plus our nominal yields minus our inflation, we get a real yield of 1.16. Really, we think the real yield should be around 2.5%. So inflation being this low, we've got to start to see interest rates go up when the economy starts to pick up, and when we start to see wage growth and a little bit more inflation. That's kind of the picture that we see, is increased interest rates going forward. If that's the case, we really want to make sure that we're careful with the bonds that we own. And we'll talk about that. I think that's the next slide. But before we talk about that, let's talk about the Fed a little bit. So the Fed has been printing money for the past few years. At this point, it seems like they could be pushing on a string. And when I mean pushing on a string, so they're printing money, they're buying bonds and putting money into banks, and then banks are simply saying, we don't want this money, we're going to put it back on the Fed's balance, or back to the Fed, and the Fed is going to have excess reserves. So you can see the Fed's balance sheet liabilities have been increasing, and almost all of it is excess reserves. So we don't really have our other liabilities. They're going up a little bit. Required reserves not moving anywhere. But you can see the added assets that the Fed is printing money, and that's why their assets are going up, because they're buying treasuries and they're buying mortgage-backed security, agency mortgage-backed securities. You can see both of these going up. So total, their assets are going up, but their liabilities are going up because banks are taking the money and then just putting it back at the Fed. So it's like the Fed is taking money out of the top desk drawer, opening the bottom desk drawer, and then putting it in the bottom desk drawer. So with this QE that they're doing, it's not affecting the economy all that much at this point, and we believe that any marginal increase is not going to have that much benefit to the economy. So we're very glad to see that they're reducing that. Yesterday they came out and lowered their quantitative easing buying to $45 billion a month from $55 billion a month. But even with that said, that means that they're increasing this number right here by $45 billion every single month. So that these assets are still trending upward, and they're just trending upward a little bit slower than they were before. When that QE is done, we want to be cautious, because that could set off some triggers, some psychological triggers for folks who think the economy can't handle the pressure of not having this liquidity that's there. But as you can see, most of the liquidity is not really going into the system. So although we're definitely cautious about it, it might be a self-fulfilling prophecy and not so much reality. But we definitely want to keep an eye on that. Credit conditions, banks are not really lending out money right now, especially when compared to what they were doing. Mortgage originations have had a little bit of a recovery, but you can see lending standards for an approved mortgage loan, your credit is at 740 almost, compared to closer to 700 back a few years ago. And then recently, mortgage originations have actually come down. That is most likely due to the increased interest rates that we had in the summer of 2013. That might actually improve now that interest rates have come back down a little bit. But you can see the common equity as a percentage of total assets for banks is at levels we really haven't seen since the Great Depression. So banks are acting very cautious during this period of time, which they have a right to be, since they got hurt so much in the financial crisis. They're taking it real slow right now. This page looks at high yield bonds. The top chart shows the spread between the yield of the JP Morgan Domestic High Yield Index and the yield on comparable maturity Treasury bonds. The bottom left chart shows historic default rates for high yield bonds, and the bottom right chart shows mutual fund and ETF flows into the high yield market for various years. Interest rate movement. So I talked about we wanted to be careful of what type of bonds we own. I've had a lot of questions in regard to our bond portfolio and how we're positioned. We are positioned very short duration, and when I mean short duration, I mean if we look at CDs are pretty easy to understand. If you lock your money up for 5 years in a CD, they're going to give you a slightly higher return to lock your money up for 5 years, versus a 6-month CD where they're not going to give you a very high return, but your money is also not locked up for very long and you can do something else with it. Well, that's kind of how our bond portfolio is positioned right now. We are definitely on the short end of the curve when it comes to duration. Just to give you an idea, these are all treasuries. So a 2-year treasury, a 5-year treasury, TIPS, 10-year treasury, 30-year treasury. If interest rates, if the 10-year treasury rate falls or rises by 1%, it's going to affect short-term treasuries a lot less than it's going to affect long-term treasuries. So just to give you an idea, the gray is an increase of the 10-year treasury by 1%. If the 10-year treasury goes up by 1%, then a 2-year treasury will approximately go down. The price of the 2-year treasury will approximately go down by about 2%. On the flip side, if interest rates go down by 1%, then your 2-year treasury price will go up by 0.8%. So yes, it affects it, but not very much. You know, your price of your bond is not going to fluctuate all that much with increases in interest rates. And that makes sense because you're only locking your money up for 2 years with the 2-year treasury. On the flip side, if we're locking our money up for 30 years and interest rates change, well, that's going to have a huge impact on the price of that bond. So you can see here, if interest rates, we have a 30-year treasury and interest rates go up 1%, well, our bond price is going to fall by 16.4%, or approximately. These are approximate numbers. If the 10-year treasury goes down by 1%, your 30-year bond is going to go up by 21.2% approximately. And so you can see the shorter duration, the less interest rate impact. The longer the duration, the more interest rate impact. So we believe that interest rates are going to continue to go higher. And so we are willing to give up some current income now in order to make sure that our bond portfolio isn't hurt as much on a price depreciation if interest rates do increase. Now, not only does duration play a factor, but the kind of bond you hold. Floating rate securities, which we hold a good chunk of, are very lower interest rate. They have a very lower risk to interest rates. They don't fluctuate when interest rates change. Versus muni bonds that have big fluctuations to interest rates. Investment grade corporates, same thing. Mortgage-backed securities, U.S. aggregate, so a combination of all of these bonds, high yield, and so on and so forth. So we have things, our thoughts are that interest rates are going to continue to increase, and that we want to make sure that we're in some of these things that aren't impacted as much with interest rates. With that said, we still need fixed income in the portfolio. Just because we believe interest rates are going to increase and bonds are probably not going to do as well over the next few years, or at least that's our opinion, it doesn't mean that we want to abandon the bond portfolio altogether. We don't know what's going to happen next year, tomorrow, the next 5 years. We definitely have our opinions put into our portfolio, but ultimately we want to make sure that all of our clients' goals are hit, and to do that we need to make sure that we have a diversified portfolio so that no matter what happens tomorrow, if our clients need money tomorrow, we have somewhere in our portfolio that we can take money from. So this is also another interest rate chart here. It just shows that when interest rates are low being below 5%, increases in interest rates are usually correlated with positive stock returns. Once you get past 5% and we start to go higher, now we are correlated with negative stock returns. So as long as we're under 5% with the 10-year Treasury, in the past it's been a good thing for stock movements for interest rates to go higher as long as we're not above 5%. The story behind that is it means the economy is improving. That's what's making interest rates increase. Well, if the economy is improving, then stocks are going to do well. So that's kind of what this chart is trying to show, just showing the correlation here between stock movements and interest rate increases. And you can see, when we're at, call it 2.5% like we are now, we have a positive correlation between increases in interest rates and increases in stock returns. Once we get past 5%, now it's a negative relationship. International markets. Okay, so we remember what we were looking at before was the S&P 500, and not all peaks are created equal. Well, now we look at the developed international index. You can see it's only up 83 only compared to the S&P 500. It's only up 83%. I just caught myself there. Only 83%. That's kind of funny. Anyway, you can see that we're not even up to the old levels that we saw back in 2007 on the developed international index. Now, there's a reason for this. Europe's gone through a double-dip recession. International markets, the earnings are not back to where they were in 2007, but there is a disconnect between the price levels. And you can see it, in July 2007, we had a price multiple of 14.5. We're below that. Currently we have a great dividend in international stocks. We get 3.1% for sitting there and waiting for stock prices to recover. We're getting paid 3.1% as a dividend yield. That's a wonderful dividend yield, in our opinion. So you can see that this is just trying to show the differences between the domestic equities and international equity. International has definitely lagged over the last 5 years compared to U.S. Manufacturing momentum, we do see a lot of positives here. Green is, when you see dark green, that's a positive, and you can see that we're trending compared to where we were just a few years ago, 2 years ago, especially in the Eurozone. It's looking a lot better. We see a lot more greens here, and we see a lot more numbers that are above 50, and actually, you know, a pretty good amount above 50. So manufacturing momentum looks strong, and you can see that by this chart here. Like I said before, Europe has gone through a double-dip recession. They chose austerity as their preferred course of action, as opposed to as much monetary easing as the United States did. The good thing about that is they've kind of felt their pain, and we can see that by they felt their pain. They haven't recovered as much as the U.S. Now going forward, we have a tailwind. What was once a 3% austerity or fiscal drag is now only going to be a 1% fiscal drag for the next two years. That's going to be a tailwind for some of these Eurozone countries. So that's one of the reasons that we're very optimistic about developed international, Europe in particular. Valuations, just as another way to look at it, developed markets seem like they're becoming more fairly valued. International still seems a little more attractive than domestic. You can see that. Here are the blue dots are where we currently are. The brown lines are the historic average. If they're below this line, then they're a little undervalued. If they're above that line, they're a little overvalued. And you can see that, you know, for the most part, if we look at the EFA, if we look at developed international, or we look at the all-world country index here, we're pretty fairly valued when it comes to developed countries. It really depends on what country you're looking at. United States may be a little ahead of itself, but we also are in a very low interest rate environment. So you could make the argument that PE multiples could be higher during this period of time. Valuation metrics could be higher during this period of time. Now, if we contrast that with emerging economies, you can see that emerging economies as a whole are actually attractive. They're below their long-term average when it comes to valuation metrics, and still in a low interest rate environment. So we believe that emerging markets, although it's been very choppy and it's been very tough to be in emerging markets over the past couple of years because it's dragged down performance, we believe there's a huge opportunity in emerging markets, especially in the BRIC nations. And we believe that there's going to be some strong performance in these areas going forward and in the long run. Yield alternatives, domestic and global. We'll just put this slide in here to show, you know, 10-year government bond yields versus some equity dividends and some REIT dividends. You know, the U.S., we're getting a little bit better return if we're in a 10-year treasury than we are in stocks by slightly. But if you look at international, we're getting some very good dividend yields in comparison to some of the 10-year government bond yields. So that, you know, equity dividends internationally look very strong, and that's one of the reasons that we feel comfortable putting a little bit of money internationally is we're getting paid to wait for some of those areas to show us their recovery. REITs, similar story. We've got some decent returns or yields from our different country REITs. And if you look at a global REIT, we're talking 4.3% yield. And then you can see over the long run, the S&P 500 total return. We just broke this into decades, and you can see how much of the total return comes from dividends versus capital appreciation in different periods of time. And although capital appreciation was big in the 80s and 90s, dividends were basically just kept us from, kept us slightly negative instead of being negative by almost 3%. And then if we look at the entire time, dividends make up half your return, or close to half your return. So we want to make sure that we're looking for instruments that are not just going to have price appreciation, but those that are going to give us a good dividend for holding them as well, especially in a low interest rate environment like we currently have. One of the reasons that we are still positive for equities is this picture right here. And this is a new chart. We've had this slide here, but JP Morgan actually added this slide, which I think is a good portrayal of it shows a little bit better illustration of how much cash in comparison to history that we actually have on the sidelines. So cash right now is paying next to nothing. We're losing purchasing power when we put our money in cash, because inflation, although it's low, is still higher than what we're earning from a 6-month CD. If you look at the 64% of nominal GDP, money supply as a percent of nominal GDP, if this were in line with the average of 52.7, that would equate to 1.9 trillion more dollars that are in cash now versus if we were at this long-term average. So that just gives you an idea. 1.9 trillion is a significant amount of cash above where we normally are, or the average of the last 30 years, call it, with our cash holding. So this could be investors and banks and institutions just being cautious and treading lightly after the 2008 and 2009 recession. At some point, investors are going to demand more than 0.4% for their money. You can't just sit in cash forever, and we believe that could help that could help stock prices reach even higher levels than they are today, with some infusion of cash getting deployed into new investments. The table on the top here shows mutual fund flows over time. The bottom left chart shows flows into ETFs and mutual funds, and the bottom right chart shows the difference between flows into bond mutual funds and flows into stock mutual funds. This page makes it clear that investors have embraced bonds since the financial crisis, but we do see that that trend has reversed slightly more recently. This chart here shows stock valuation measures. Valuation measures in general right now are pointing to a fairly valued when you look at historic context. I mean, we can just look here. Our long-term, our 15-year average for PE multiples is 16. We're at 15.2, not far off. Our price to book, 2.9 versus 2.8. Our price to cash flow, 10.6 versus 10.7. Price to sales. So you get the picture. We're fairly valued when you look at a historic context, but this 15-year period of time, interest rates have not been this low for this long as they have over the last 5 years. So you could make an argument that stocks still look cheap with the backdrop of very low interest rates. And then when you look at stocks versus bonds, and you look at the earnings yield, which is just the inverse of the PE multiple at 6.6% versus the Moody's BAA yield of 5%, you can see that stocks are relatively inexpensive compared to bonds, as opposed to in 2000 when we had a huge gap the other direction when bonds were significantly undervalued in relation to stocks. However, this gap has definitely closed. You know, a few years ago, we were much more adamant about this gap. We're starting to close that gap very quickly. But you can see, you know, usually we get these cross currents, and so it doesn't stay stable for very long. Why are PE multiples so important? They don't really help us. This chart just gives us an idea of why PE multiples, why valuation metrics in general, in particular the PE multiple, why it's so important. Over the short run, it's not important. It doesn't matter. You can see that by looking at PE multiples and total return 1 year over 1 year periods. So if you look at the PE multiple and I say, okay, the PE multiple is 15, what does that tell me? What should my next 12 months stock returns be? Well, I can't tell you. There is no pattern here whatsoever. There's dots everywhere. If the multiple is 20, yeah, we've had less time when the multiple has been 20, but I can't tell you where the stock returns are going to be. They're all over the place. But if I say, okay, well, let me see what the PE multiple is, and then let's look at returns over the next 5 years, and does it give us some sort of pattern if we look at 5 years? That we have a lot better plot here. We have a lot better regression, and we can see that PE multiples do a lot better job at predicting what the next 5-year annualized returns will be versus if we just look at 1-year returns. The lower the PE, the higher the return the next 5 years, or at least that's what this regression is showing. Corporate profits. Corporate profits in quarter 4, 2013 were record earnings per share for the S&P. So far in the first quarter, we've seen actually pretty decent growth with the companies that have reported. It looks like we could have about a 5% growth in profits for the first quarter, which is very good. And you can see that we're doing this with much less leverage than we were in the past. The last 20 years, our average, the S&P ratio of total debt to equity has been about 171%. That is down to 104%. So these, like I said before, companies, banks, companies and corporations are being very cautious when it comes to how much leverage they're putting, how aggressive they want to be, but they're still getting the job done. So at some point, we could start to see greed come back, and these levels go up, and that'll help earnings. And at that point, that's when we want to be very careful. But it's hard to paint a picture where we're getting ahead of ourselves. Even though the stock market's done well, it's hard to paint a picture when you look at corporations and you look at leverage ratios, and we're at 104%, and we have lots of cash on the balance sheets, and it's hard to paint a picture where we're going to have a horrible or a big drop in economic growth. It's just real difficult to show that. It's not to say that it can't happen. It just appears that we're not in the position where we're going to fall from the 6th story of a building, because we're only on the 1st floor still. We haven't got ahead of ourselves. Confidence, earnings, and multiples. I put this in just to show the relationship between a rise in consumer sentiment. I said, consumer sentiment has a lot to do with multiples. So you can see the gray line here is consumer sentiment. As it increases, our PE multiples, or what people are willing to pay for stocks, cash flow for stocks, it increases. The correlation coefficient is 0.52, showing the forward PE multiple of 15.2, and showing operating earnings estimates for the 1st quarter at 123. We late last year, actually, yeah, I think it was late last year, maybe early this year. We heard a well-known economist, James Paulson, who is the chief investment officer at Wells Capital Management. He made a compelling case for operating earnings for the S&P 500 to be at $135 a share, so roughly $12 a share higher in 5 years from now. And he also made a compelling case for a multiple of 20. A big reason for that is he's attributing it to low rates and a very good economic backdrop to have some good earnings. If we had $135 operating earnings and we had PE multiples of 20, that would equate to an S&P 500 of 2,700. And that would also equate to approximate returns of about 10% annually for the next 5 years. Now, I also saw Jim Paulson back in, I think it was 2005 is when I saw him, and the S&P 500 was right around 14 or 1,500, and he made a case for the S&P 500 to be at 1,900 over the next couple of years. What he didn't realize was that we would fall into a recession and see 670 on the S&P 500 before we went back up to where we are now, which is close to 1,900. So he eventually is going to be right. We're a stone's throw away from 1,900. He just was off by when it was going to happen. And that's where most folks get themselves into trouble, is their time frame. So we always want to make sure that we are diversified. And I know I said this before, but I love to put this in here for a couple of reasons. The first is we have a 3-asset class portfolio since 1994 to 2012. This portfolio had a return of 7.43% and a standard deviation, i.e. risk, of 10.8. If we add some asset classes and make it a more diversified portfolio by adding, market neutral and commodities and REITs, we already had the S&P, so we reduced our S&P exposure, but we added some of these other things. We added small cap, we added international, we added emerging markets, and then we reduced the amount we had in bonds by a little bit. If we were to have this more diversified portfolio, we actually have a return of 7.72%, which is higher, with a standard deviation that's lower, almost 1% lower, and almost 30 basis points higher return. So you're taking less risk but getting a higher return. That is what diversification helps us do. And then the other thing I like to put in here is the Dalbar study here, and they actually finished their 2013 study. We don't have it. We don't have the updated results here, but it's not far off from this. But you can see the average investor return using the Dalbar study is 2.3%, which is less than inflation, which is less than bonds, which is less than stocks, which is less than REITs. Case in point is most investors don't have the correct time frame, and they end up having to sell at an inopportune time, or they're chasing returns. We want to start with a diversified portfolio, make sure we're rebalancing, buying the things that aren't doing so well, selling the things that have done well, keeping this diversified portfolio, and making sure that we have the right time horizon so that we can get better rates of return instead of getting what the average investor gets because they're jumping in and jumping out of the market and chasing returns and doing a lot of the other silly things that some investors can do in emotional states. Time horizon is almost one of the most important things that a financial advisor can pull out of a client. You know, if somebody comes into our office and says, "I've got 1 year to invest," we're gonna tell them, "Well, you better put your money into a high yield savings account or a CD that matures in 1 year," because we're not really going to tell them that they should be investing in the stock or bond markets. They are just too volatile. We're trying to invest for people so that investors can make money. And a 1 year time horizon puts too many scenarios on the table where investors lose money. You know, stocks, yeah, you could make 51% the last 63 years. The highest S&P return has been 51% in 1 year, but the lowest has been negative 37. So that's just way too big of a range for us to tell somebody with any confidence. You know, we don't know what's going to happen. No one does with that big of a range. Bonds, a little less range, but still, we don't know what's going to happen. If we were to do 50-50, 50% into stocks, 50% into bonds, still, there's too much downside on the table for a 1 year period of time. It's just not long enough to have your assets in stocks and bonds. So what do? We increase the time horizon. Well, now if you have 5 years, now I don't know that we want to mess with all stock if we only have 5 years, because we still have had periods where we lost 2% in both stocks and bonds. Why don't we look at a 50-50 mix? Okay, well, there's not been a 5 year period of time where a 50% S&P, 50% Barclays aggregate portfolio has lost money over 5 years. That's great. Now we're putting the odds into our favor. The more that you increase this time frame, the better we're putting the odds in our favor. So that's just one thing we like to point out at the end of these, is we want to make sure we have the right time horizon. Now, over the long run, history has shown us that you get paid a little bit more for taking a little bit more risk in stocks than you do bonds. But you can really diversify and reduce your risk and not give up so much return with a 50-50 portfolio or some iteration of that, and reduce your risk, but without giving up too much of your growth on your money, and still be able to hit your goals. So that's something that's very important to us as well. The other thing that's always good to point out, especially when we haven't seen too much volatility in the market the last, call it 18 months, we really have the worst pullback we've seen in the last, gosh, almost 2.5 years was 10% back in 2012. 2013, the worst we saw was 6%. So far in 2014, the worst we've seen is about 6% as well, and that was early this year. That's not the norm. The norm is that despite intra-year drops of 14.4%, so we're saying that even the average intra-year drop is 14.4%. That's the norm. Is volatility. We haven't, the last couple of years has not been the norm. We've seen markets kind of go up. We need to be ready for the norm, which is volatility. And when we have volatility, we're going to see our portfolios fluctuate. But even with that said, annual returns have been positive 26 of the last 34 years. So volatility comes with the stock market. We're going to see volatility. There's no way around it. That is why stocks over the long run have paid more than bonds, because you're taking more risk. So that's just something we want to keep in mind. Investment implications. So even though commodities have had a good run-up recently, we still have an overweight in commodities. We still have an overweight in floating rate bonds. They're just not as interest rate sensitive, and we still believe interest rates are going up. Market neutral is another way we can get a part of our safe portfolio without having too much interest rate exposure. Emerging market equities. We're very, very bullish on emerging market equities. They just have been, there's been a lot of headline risk. They've been hurt a lot. They have not performed as well as other markets over the last 3 years, and we believe that there's some opportunity there. Underweight, long duration fixed income, we went over that. Treasuries, and believe it or not, domestic equities. We're not hugely underweight domestic equities, but we'd rather be in some international stuff that's given us a little bit higher dividend. But we still have a big staple of domestic equities in the portfolio. So that's kind of where our investment implications are. Last slide before we have questions. It's been a pretty choppy last 10 years. And even with that said, a diversified asset allocation has returned 100% over the last 10 years cumulative total return, which equates to 7.2% annualized basis. That is not something to that's not something to scoff at. 7.2% is a good return, and that's with one of the worst years in most asset classes history, 2008. So 7.2% is definitely a decent return when you're looking at an asset allocated portfolio that has diversified out some of these risks. And it's a lot better than what cash has done over that same period of time. And it's a lot better than what bonds would have done by themselves over that same period of time. So that's what we're trying to get across to folks is it's important to have some of your money in these more aggressive assets, but also that we want to have some of our money in these safer assets because depending on your time horizon and your goals, you could need some of the money in a shorter period of time, and we need to have some of those assets in safer type things. But 7.2% total return on an annualized basis is not something that most investors would be mad about. And with that said, I'm going to open it up to questions. I'm going to have Nick go ahead and handle the questions here.
Hey, thanks a lot, Scene, and hi again, everybody. This is Nick Basso again. At this time, like Scene was saying, we would like to open up the webinar to questions from the meeting attendees, and we would invite you to please gather your comments and questions and type them into the chat box that is attached to your GoToWebinar toolbar, and we'll give everybody a few minutes to kind of catch up with their thoughts.
Are there any questions, Nick?
Nope, we don't have any questions for this quarter's webinar. I guess we may as well go ahead and conclude.
All right. Well, thank you for everybody who joined today. The next quarterly webinar will be the first Thursday of August. I'm not sure what day that is. I think it's the 7th or 8th. But we'll send out an email reminder. As always, thank you for joining us tonight. That concludes our Market Insight webinar. Thank you. Good night.